In this lesson, we are going to cover support and resistance zones as well as the support and resistance levels. So let's get straight into it. Starting off with support. Basically, support is the zone that tries to withstand the price and prevent it from going further down. Support will cause the price to bounce up, and basically this makes it the best place or the best zone to place your buy entries. Whereas the resistance zone is that zone that withstands the price and prevents the price from going further up. So it basically creates a ceiling for the price. Resistance is what caused the price to bounce down and basically making it the best place for us to enter or sell trades. As you can see, it's clearly illustrated here on your screen. So our resistance zones are basically the selling area and our support zones are the buying areas. And just like we said about the supply and demand zones, the higher the time frame, the more accurate and more stronger these zones are for us to use compared to the ones on the lower time frames. Now let's talk about the levels themselves, the support and resistance levels. Now with the support and resistance levels, they are more detailed and different from the zones. Remember, the zones is a larger area, but for the levels is basically a level that is more detailed to the price. That is a level where the market has had more touches either to the upside or to the downside, and the market cannot break through those support resistance levels. So level is one line and a zone is a zone, right? It's a thicker area. It covers a thicker area. So here's some examples on your screen to illustrate what I'm explaining here. So with the resistance line, as you can see, it's a thin line that touches the most touch points on the market, right? Same as the support line. You can see here we have about at least 3 touches on this line, right? And you need at least 2 points to actually plot these resistance and support lines on your chart, right? So as you can see with this illustration over here, but compared to the resistance and support zones, as you can see, it covers much more area. It's thicker, it's wider, and it's basically a zone, right? Compared to a line, as we're saying about the resistance levels. So there are some rules that you need to understand about support and resistance levels. So these are the rules that you need to keep in mind. Always look left first because the market leaves clues, right? So always look left first for the clues so that you can know where to plot your support and resistance. As we said, you need at least 2 points to be able to plot these zones and these levels on your charts, right? The second rule is to remember that we only sell at the supply zone, bringing us to our third rule, which is to remind you that we only buy at the demand zones, right? So at supply, we sell, at demand, we buy. And then the last but not least, always use a stop loss when you enter these trades. Even good setups are not guaranteed trades. They are not guaranteed winning trades, right? So always use stop loss. Always stick to your risk management rules. That's the rules that you need to keep in mind over there. Now, most of the time we do not use stop losses when trading NASDAQ because we scalp it and choose to rather close manually when we see our setup is no longer valid. Now, the reason why we don't use stop loss is because we use risk management and we know that our account can handle drawdowns up to a certain point, right? And we also trade with money we are willing to lose. But at the same time, we also make use of trailing stop losses. So trailing stop loss will basically allow us to lock in some profits so that in case of some fundamentals, we are able to leave the market with some money. And at the same time, it allows us to catch the massive moves as well in the case that the market actually continues and breaks through the resistance levels that we'll be looking at. Remember, as we said, NASDAQ mostly breaks through these resistance levels, turning them into support levels for more entries. Another reason we don't use stop losses is because NASDAQ always hit our stop loss, then moves into our direction. So that is another reason why we don't use stop losses. So each and every one's situation is different. For us, as we said, due to NASDAQ hitting our stop loss most of the time before going into our direction, we'd rather use manual stop losses than actually putting them on the market. Now, just because we don't use a stop loss doesn't mean you should do the same thing as well. Remember, everyone's situation is different. So trade according to your own situation, according to the drawdowns that you can handle on your account. With enough practicing and training, you're also developing a trading way that works for you, your own trading plan. So that's it for this lesson. Let's move on to the next lesson where we're going to talk about the 3 moves that you need to keep in mind at all times. Let's get into it. Okay, so now that we have spoken about the support resistance levels as well as the zones and the supply and demand zones, in this lesson we are now going to cover 3 important moves that you should always keep in mind. And those moves are basically, the first one is the rally, which is influenced by the buyers, and then we have the space, which is basically when the buyers and sellers are equal in the market, and then we have the drop, which is influenced by the sellers. So let's get straight into it and explain them more in detail. Starting off with the rally. So with the rally, we're basically looking at the buyers. This is when the buyers are jumping into the market and basically they're pushing the price up, right? So an uptrend. After the rally, we have a base. So base is when we have both buyers and sellers in the market. They're basically almost just as equal, right? So that means the market is now stuck in a box. It's now stuck at a base where it's just ranging between two levels, right? Between a support and resistance level. This is what we refer to as the base when the market is consolidating. After the base, we have what you call the drop, right? So the drop is where the sellers are in full control and they're pushing the market to the downside, making lower lows and lower highs, right? So that is what we refer to as the drop. Now, classifying this further, we have what we call the continuous base. And the continuous base can be classified further into two different types. The first one being the drop-based drop, and then the second one being the rally-based rally. So basically what we mean by continuous base, it is a kind of a base that continue the direction of the initial price trip before the base occurs, right? So if the market was going in the up direction before the base occurs, it will continue in that same direction, right? If it was going down, the same, it will continue the down trend after the base, right? So that is what we refer to as the continuous base. There are two types of these continuous bases. The first one being the drop-based drop, which is in line with the supply zones. And then we have the rally-based rally, which is in line with the demand zones. Looking at our illustrations right here. So the first one here, we have the drop-based drop, right? So as you can see, we start off with the drop and then we have our base over here where the market is consolidation. And then that creates our supply zone over here where we have our entry when the market comes back to retest that level over there that is broken. Remember, when a support level is broken, it turns into resistance. So that's where we will have our supply zone over here and basically look for our entry points, right? As you can see, after the drop, then the base, we had the price continue in the direction of the drop, which was the initial move before we go to the base. Now, inversely, looking at the rally-based rally, we basically have a rally, which is an upward move first. Then we have our base over here. And then after that base, we have a retest over here, which allows us to enter the market and then continue with the initial trip, which is the upward move over here. That is what we refer to as the rally base rally. So those are the three moves that you need to keep in mind as they're important, and this is the cycles of the phases that the market is always moving in. Remember, the market repeats itself all the time, right? So you need to grasp this and understand these movements so that you are able to understand when to enter a trade, when to be patient, and when to exit your trades. So that's it for this lesson. Let's move on now to phase 3 of the course, where we are going to talk more on NASDAQ as well as the fundamentals that influence it, and basically how you can also master NASDAQ the same way that we are eating here as the big boys. So let's get straight into it. Welcome to phase 3 of this big boys course, and in this phase we are going to explain to you all the secrets that you need to understand about trading NASDAQ 100, all the fundamentals that influence it, the amount of money that you need in order to trade NASDAQ with proper risk management, also what type of things that you can look at if you want to trade NASDAQ with low risk, less stress. And basically we're going to show you all the type of examples that we've been able to catch, the type of setups that you can expect to catch when it comes to NASDAQ 100 in order to make some money out of it, right? So trade like the big boys. I'm sure you've been seeing all the results that we've been sharing, how we are killing NASDAQ 100, right? So all the secrets that we've been sharing in this course, and then you put it together with these fundamentals that we're going to be talking about in this section. That is exactly what you need in order to kill NASDAQ 100 or any market for that matter. So let's get straight into it.